Now, please welcome our last presenter, Mr. Ben Nadareski. Please come up to the stage.
Hello, everyone. My name is Ben Nadareski. I'm the co-founder and CEO of Solstice Labs. I also think I'm the last talk for today, so everyone can get out of here after this one. We are a stablecoin provider and yield protocol that is launching this month with over $150 million of capital and a leading staking infrastructure provider with securing over $1 billion in assets. As a brief background on myself, I started my career in crypto, or as a derivatives trader originally on Wall Street before entering crypto in 2013. And I've worked at institutional firms including R3, Consensus, Six Digital Exchange, and Galaxy Digital. And I want to talk to you today about how the DeFi industry are bringing sustainable yield strategies to Onchain, and how institutions and DeFi protocols are deploying these yield strategies as well. So everyone looking at the DeFi industry right now wants institutional capital to come into DeFi. This is a narrative that has been reiterated almost every single day across all of the different applications in crypto. And everyone in the TradFi world is wondering, on the yield side, when they're looking at these DeFi yields, well, let's start off with the assumption, what if US Treasury bills are not really the risk-free rate? So where else can I start to look for sustainable yield in the market? And what if there was a better way for these yield opportunities to be accessed? DeFi yields have traditionally been capped at low liquidity without battle-tested strategies or institutional backers taking a stake in the operational development of the protocols. It's the first time today, and leading up in this year especially, where institutions are seeing something they can relate to with the inflow of capital on the edge of entering into the DeFi sector. So the current iteration on both sides is currently broken. This is where the need for this yield strategy on DeFi is really coming into play. Most professional platforms require accredited investors who meet certain requirements on the private investment side to have, minimum access of 100,000 US dollars, high fees, and most importantly, the direct access of third-party financial advisors to allocate those funds. In DeFi, while everything is on-chain, things are often hidden by organizations off-chain. And this has been an issue that we've experienced over the last several years in the DeFi industry. And most of the hacks and breaks in the DeFi protocols that have been providing these yields have all happened off-chain. This is not a blockchain issue, this is a trust and transparency issue. And so both sides have started to converge in solving these problems and meeting somewhere in the middle where DeFi protocols now become a strategic investment vehicle for leading institutions. The DeFi side still needs to evolve a little bit more to create a safe haven for institutional capital, which is what I'm here to talk about. Each by itself might not work for everyone, but something in the middle can. And institutional capital can work within regulated frameworks, things like tax preps, audits, jurisdiction licensings, etc. While most institutional capital still can't access the DeFi protocols simply because they can't report it the right way. And DeFi wants institutional capital, but it isn't willing to meet them in the middle where they have to onboard it. So this is where Solstice comes into play, in the middle of TradFi and DeFi. And very explicitly, these are some of the driving columns and factors in our industry that are leading the institutional bridge of capital over into the DeFi sector. Collateral stability is number one. Having enough backing of principal for depositories is critical. If you don't have user funds, then we've seen this play out many times. DPEGs occur in stable coins, RWAs get low liquidity, and we've seen funds pull out. Collateral stability is key. Number two is audits, a track record for over-collateralization from independent third parties, which we're starting to see a number of firms in the DeFi sector offer for institutions come in. For some yield protocols, it becomes tricky to prove off-chain assets in sexes or RWAs, for example, but these are starting to become reported in the correct ways. Ensuring your protocol has public audits often is a helpful way to help them build trust in the user base. Liquidity markets is a very key factor as well. So when you're going, it gets tough, the tough needs to stay pegged, as we like to say. You need to be able to have high liquidity markets, which has been one of the major blockers for access over for institutions over. A lot of DeFi yield protocols cap out at $5, $10, $15, $20 million. And the major institutions that want to deploy know that a significant investment size, that's not going to cut it in order for them to take a stake in a DeFi protocol. You need a diverse user base, we want to have protocols that effectively have a diversified wallet share of the core capital and a widespread market on a global basis. You need a growth engine for these DeFi protocols, and you also need an ecosystem to support this. So wrapping all of these core pillars up, what could this look like? And when combined properly in the principles from the previous slide, you start to get the best of both worlds here. So deep DeFi liquidity and DeFi's permissionless access with institutional involvement and the regulatory transparency that would be expected. And whether if you have 50 yen or 50 million yen, these protocols such as Solstice are ready for institutional capital. Solstice is an example of the new business model for asset management on-chain for sustainable DeFi yields, where capital is introduced through a native stablecoin. Yield is generated by locking the stablecoin up in a secure, transparent custody, and then attractive DeFi yields are returned back to these investors. In our case at Solstice, we have been executing a dynamic delta neutral strategy across sexes, such as Binance, with hundreds of millions of dollars of capital in a sustainable way. These returns are consistently double-digit, transparent, and permissionless to access. The whole concept that there's these very exciting yields in DeFi, there's institutions that want to get in, and there's no correct bridges that currently exist. We've been doing this at scale at the Deus Ex Capital level, who I also represent. It's a $1.5 billion asset manager out in London. And Solstice grew out of that to focus on a decentralized protocol that will allow for both institutions to come on board and access these yields in a B2B way, as well as the permissionless access. So whether all you need is a wallet and connectivity to the internet. This business model is not just for pure trading strategies as well. The RWA model consistently has shown that this is another route for yields in the DeFi sector that are starting to pour institutional capital into the DeFi industry. So finishing, this is exactly where the convergence comes to light. This is an example of a direct application that is driving institutional capital into DeFi markets, and you're going to see a lot more of these evolve as we have seen over the last 12 months coming in the next 2 to 3 years. To learn more about us at Solstice, you can follow us at solsticelabs.io, which will turn into solstice.finance coming up in our September launch coming up. And you can also follow us on X at solsticefi, solsticefi. Thank you so much.